Will an investment in Alibaba, the Chinese conglomerate, take your portfolio to the magical land of 1,001 nights? I'm sure a lot of you know what Alibaba does. It's the Chinese conglomerate. It's the Chinese equivalent of Amazon.com. It enables retails, but also business buyers around the world to buy Chinese goods and products. And it's been very successful since more than 25 years. But there's a component to Alibaba that's different than Amazon, and it's this. Alibaba connects not simply consumers with the product that they're searching to buy, a book or whatever it is. Alibaba does a thriving B2B business, which enabled it, as China was supplying more and more products in the world at large in the last 15 to 20 years, it was the middleman, so to speak, in the Chinese industrial growth that we know so well. As China grew, as the export market grew, as the internal market grew, Alibaba's stock did very, very well. If you'd bought it when it was initially launched back in the 1990s and you'd held onto it, you'd be a multimillionaire many times over. Why was it so successful? It was successful, as I said before, because it had a clean, direct business plan to provide online retail and commercial wholesale business. And that led the stock price at its height some time ago to over $300 a share. When I'm quoting you a price in US dollars, say over $300 a share, bear in mind that that's the ADR, the American Depositary Receipt, for the underlying Chinese shares. But what happened to Alibaba that accounted for its losses from over $300 a share to where it's trading today at $70, $80, $90 a share? Well, obviously the pandemic, the virus, which began in China, had an impact on its business. So that's an important factor in trying to understand why the drop in the price of the stock. The second is that the Chinese government, while it embraces and in a way celebrates the success of a company like Alibaba, is at the same time a little nervous at it's been so successful and the company's had regulatory scrutiny. So we've seen the price of the stock come way down. And the question we have to ask ourselves as investors is, does this represent a buying opportunity? From a price earnings standpoint, not a great measurement with a company like this, but something of an indicator, or market capitalization. You've got Amazon valued at $1.5 trillion, and you have Alibaba's market cap at about $250 billion. So there's a big discrepancy in the overall market capitalization of these two companies. But the second is that the management of Alibaba has been, in the last several weeks and months, been buying back its stock. What does that mean? It means using the company's capital to purchase stock in the open market, which generally serves to increase the price of the underlying stock. I would say, although I'm not privy to any insider information, but that the regulatory scrutiny of Alibaba will probably recede in the coming months or the coming year. And the presence of a stock buyback program does indicate that the management, which sits on the company and sees it every day, believes that the shares are undervalued. So for you as an investor, you've got to look at whether you think the revenue from the pandemic, from the slowdown because of disruptions in the global economy, will keep Alibaba from growing in the months and years ahead, or whether this represents, which it could very well represent, a buying opportunity of a company that's well managed, well positioned, and trades at a discount to its fair market value. That's all the time we have today on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukas Copy TV. Remember, money can take care of you. It cannot take care of itself.